Hello, trade pros. What is up? Welcome to yet another video. I'm super excited for this video because this video is going to break down moving averages like you have maybe never seen them before. And it's going to give you one consistent, right, concise plan that will help you understand how to actually trade with moving averages. So this is the only moving average strategy that you're going to need as a swing trader, right? And I hope you guys enjoy this video. I hope you guys like this video. Smash that like button, hit that subscribe button if you're not already subscribed, and ring that little bell to notify when we drop videos like these. So in today's video, what can you expect from this? I'm going to show you a very simple trend trading strategy, the only moving average trading strategy that actually works that you will need to know. So why don't we start with that? Why don't we break this down and jump right into this intro before we give you a little more of what we're going to be talking about today. So the premise of this video, the premise of this moving average strategy is that this average strategy can work in any market, right? Mainly what I'm going to be showing you today is going to be on stocks and different equities, but you can apply this to futures. You can apply this to Forex. You can apply it to any other crypto, whatever you want, you name it, you can apply this strategy to that. Now, what we're going to be talking about today, diving right into this, is going to be number one, the basic premise of this moving average strategy. What does it consist of? What is in it, right? Enough of me giving you these intros. Let's just dive into this. Number two, we're going to be talking about how to qualify the trade itself. Number three, we're going to be talking about entering the trade, your targets, your risks, so on and so forth. So in front of me here, we have a blank chart of Oxy, Occidental Petroleum, that's been doing very well with the energy sector in the past few weeks. So what we're going to be needing for this moving average strategy is going to be two different moving averages. And I'm going to explain exactly why and how. So the premise of this moving average strategy, before we continue, I should say that this strategy is based on bullish structure. This is going to be a bullish pullback trading strategy, right? Let's make sure we understand. It's going to be on the bull side, and we're going to look for that continued long. So what we're going to need for this strategy is to understand how a bullish trend works first, which is fairly easy, right? In a bull market or a bullish trend, what we have is going to be higher highs and higher lows, right? So you can see, we can identify that higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Now, the premise of this trading strategy is going to be to use a moving average to one, identify the trend, and then two, another moving average to actually find the pullback areas into a section. The question is, what moving averages do we use, right? There are two. The two moving averages that we're going to use that you can find here on TradingView are going to be number one, the 200-day, right? It's a 200-day moving average. So it's a simple moving average, right? Not the exponential. We're just going to look for a moving average, an MA. And here on TradingView, we're going to change it. So we go into a little gear shift here. We can make this 200. What I typically like to do is change it to a different color, right? I like orangish yellow for the movie for the 200, something like that. I'm gonna make it a bit thicker so I know, right? It's powerful. So what we've done right here is we've drawn the 200-day moving average. Now, typically, the 200-day moving average is very important for many different reasons. The first and main reason is that it tells us very confidently what is the trend of the stock, Forex pair, futures market, whatever the asset may be. What is the trend of the asset that we're looking at? So above the 200-day moving average is going to be bullish. That is exactly what we're looking for. I want a bullish trend. I want a bullish trade, right, on this moving average sequence. You can see Oxy, it's held below the 200 for a very long time, right? Since 2018, right? We've held below it very strongly. Right now that we're above that 200-day moving average, number one, it has pulled back into it a few times. We could use that as a potential. But what I'm going to introduce is going to be the second moving average. Now, the second moving average is going to be a kind of like a ribbon average. So it's going to be the Ripster EMA clouds that you can find on TradingView. And you can see there's going to be a lot of them. What I'm going to do is I'm going to make sure that I know which ones are which. And I'm going to hide the first one, right? I'm going to hide the second one. You can see what the inputs are. And I'm going to leave only the third one, the 34 and the 50. And I'm going to explain exactly why. So I'm going to leave the third one only, and that's the one that we're going to use. So I'm only going to use the 3450, right? And as long as the 3450 remains in its bullish sphere, meaning it's going to be blue, I'm going to use that moving average. Now, obviously, sometimes this isn't going to work to the exact tick and the exact T, and we're going to explain the strategy in itself, right? How to qualify, what to look for, and all that stuff. Just we wanted to explain the premise of it, right? And I chose a stock that's not necessarily picture perfect, because you can pick a picture perfect stock, right? And you can say, oh, well, it works every single time, but that's not the reality of it. So let's dive into part two, how to actually qualify a trade in itself and what we look for exactly. So we have our two moving averages, correct? We've got our two moving averages, and we got the 200 and the 3450 split. Why the 3450 to 3450? Because it's an area. The moving average isn't going to hold. It's one line. It's not going to hold to the tick, and you're going to be upset that that's the case. What we're going to look for is for a very vague area, right? 34 and 50, that area to actually hold out. Why the 3450 rather than the 9, rather than the 20 or whatever it is? It gives just enough space so it's not glued directly to the actual trend. It gives just enough space to get those larger pullbacks so we can look for those larger swings, right? So we're going to use those two averages. And what we're going to do is we're going to actually wait for two different qualifiers. The main qualifier that I like to see is when we get in and around the average, I want a nice green candle of confirmation to close out on heavier volume on a daily chart. So in this scenario, we can go step by step each time we get close to it, right? So this green candle is actually fairly strong on a volume side, right? So is this one. And what it does really well is starts to engulf some of this gap. So these rotations in and around are worth taking for the long side, right? We pull back into it. This first green candle, it's not that great, right? We come into the actual average in and around, because this is why it's an area, right? We come in and around. And what happens? We get a very nice green candle on very heavy volume. If we zoom into that, that presents us with that opportunity to get long in this area. We pull back again, right? And in this area, right, these candles, they're nice and green with a decent volume, right? That pops up. And if we get long on this trade, we're probably getting stopped out. And that is a part of trading. That is a part of trading that, yes, there are trends. Yes, there are potential continuations, but it's not always going to be picture perfect. Could we have avoided this trade? Yeah, maybe, but that's okay because we have one, two, and then the third is a stop. So what happens now? We want to see the trend continue. That means that we're not getting in blindly the second we get back above the average. Remember our trend configuration: higher lows, higher highs, higher lows, higher highs, higher lows, right? Higher highs at this point, higher lows, great. Not a higher high, a higher low, which is great, right? Not necessarily slightly a higher high, right? So we want to see a higher low in and around the average. This is not necessarily good enough in this area, right? It's starting, but the volume you can see isn't as strong as some of these cells. So we can avoid that trade until we get the trend that confirms the move, right? Now we start breaking up, right? Higher low, higher high, higher low, higher high. It doesn't pull back until about here. So let's see. Volume, again, in comparison to some of these red candles, isn't that heavy. So it starts to discourage our potential trade. Yeah, the 200-day is possible to try and get in on this, but at the same time, if I don't have my qualifiers, I can't get in on this move, right? So let's see here. Pushes up, right? Makes a higher high through this resistance, pulls back, really strong green candle, right? Could potentially get in. And then we get that push, right? Pull back, right? How are these green candles? They're not bad, right? We have a decent earnings report. And then we get that pop off that level. Now what we're doing is we have a huge extension here. And if we pull back into the average, it could be somewhere here. Evidently, a higher low could be formed. On green volume, we're going to take this thing back up. So now that we know how to qualify it, the third part is, how do we actually enter? What is our risk and what are our targets? Now, you guys may have noticed these ribbons are in here for a reason, right? We have a negative ribbon part. And I am very reluctant to take any trades until we turn positive on the ribbons. So that means even here, if we pop back up, we're not positive on these ribbons yet, meaning that we can't necessarily get into this trade. So how do we get into a trade? What is our risk? What is our target? So let's say we get into this area, right? Into the pullback area. We're long somewhere here. My risk is the close under the actual average, right? My risk is the close on a daily basis under the actual average, right? You can do it maybe on an hourly basis as well. And the target is going to be the first area of resistance, right? The first swing prior to that. And then after, we just trail based on the average, right? So for example, this trade right here, we get long somewhere here and the stop is going to be the close under the average, right? We take some profit somewhere here. So if my entry is $20, let's say, and my stop loss is somewhere $18.20, right? So not even $2, $1.80. My first take profit is going to be at $470. So that's a good risk to reward. And then we trim. What does that mean? We take profit first, and then we put our stop to break even. Next leg up, right? We put our stops under the prior higher lows as long as we maintain above the average. We close, right? Finally below the average, and our trailer might be taken out at 25.40, still a gain. So keep that in mind. Now, if we do the same exercise on a different stock, right, let's see how that will work. So let's take a look at Facebook here, because Facebook all of a sudden started trending really, really well. So with Facebook, and the nuance of this strategy is it's not going to work in a range realistically. It's only going to work in an uptrend. So this area right here is just X'd off automatically. You can't find trades within here because there's no real trend. Remember, higher lows, higher highs. We are sustaining the 200-day moving average, not so much anymore. We were sustaining the 200-day moving average very well. And at one point, we started seeing, right, those pullbacks and opportunities to get to the long side. And then all of a sudden, something happened here. So why don't we go through Facebook in terms of the entry, the qualification, all that process, and understand a little more of the nuances of the strategy. So Facebook is the same thing. Number one, are we above the 200-day moving average, our yellow line? Yes. So 200-day, are we above? Yes. 34.50, are we positive on the 34.50, right? Yes. Above this area, yes. Are we holding the 34.50 with a solid green candle and decent green volume, right? The second one right here, yes. So we can check that off as well, right? So that means based on these three things, we can enter the trade somewhere here, right? Let's say it's around $300. A $300 entry, the target is going to be somewhere up here, right? Around 330. And where's the risk going to be? The risk is going to be a close under that average, which could honestly be like even like 295. So very small risk. $5, let's say, even $2.90, $5, $10 for a $30 potential win. So profits are taken, right? What happens then? Where do we trail our stop? Now we can trail our stop at the nearest lower high, which hasn't been formed yet. So that would be somewhere here, right? The higher low at this point, plus we can trail based on the average, as long as we don't close below the average. So we push up and then we get this pop right here. After this pop, we can comfortably say our trailer is going to be somewhere here, as long as we don't close below the average. So what happens here? We come back into the average, right? No green candles except for this one. Is it on heavy volume, right? It's decent volume, maybe nothing to really write home about. So maybe we say, you know what, we skip it because the volume doesn't really eclipse any of the sell pressure. The good thing about that volume, what it does is it's on a candle that actually eclipses the prior candle. So you can use candles as a qualifier as well. Is a candle a long wick doji? Is a candle a big engulfing candle? You know, bullish candles, right? If these candles suffice, right, that could be an entry in itself. Let's say we don't enter this one. It pushes up, right? We have our stops now here, pretty much the same area where we got it. We could be taking profits, obviously. And then we could be taking some more profits here. It pulls back, no real green candle here. Nice green candle, right? Decent green candle, decent actual volume on this candle. So let's say we add into this position and we look for the upside. Finally, what happens? We get a close below the area. So 355, meaning that we've trailed it from 300 to 355 and took profits along the way. And at some point, right, when you reverse the 34.50 average and it turns negative, you can't be looking for this strategy. So let's do a quick recap here. What do we need for this strategy? We need our daily chart. It's going to be a swing basis strategy that you can use on equities, futures, Forex, right? Crypto, you name it. You can use it on options as well. We're going to look for the 200-day moving average, and we're going to ask ourselves, is price above the 200-day moving average, right? Because we want a bullish trend. Is the trend bullish? Higher lows, higher highs, right? That's the second part. Third part is, are we above a positive 3450 cloud, right? And then we ask ourselves, when we pull back into that 3450 cloud, do we get a strong rejection candle, a green daily candle that's an engulfing candle, a doji, some kind of bullish candle pattern with heavy volume? If so, we take the trade. Our risk management is below a close of the 3450, and our targets are prior tops, or see how far we can extend it trailing based on the 3450. So I hope you guys enjoyed the simple moving average strategy for swing traders based on price action, also on TradingView. And I hope you guys can take this, run with it, and find opportunities in the markets. And remember, find bullish trending stocks. You can use screeners for that and whatnot. So if you guys enjoyed this video, please drop a like. Hit up that subscribe button and ring that little bell to notify you when we do go live. This is Victoria from TradePro Academy, and I hope to see you guys around more often. Thank you and take care.